we go through the business planning process with our clients, one of the questions obviously is how do they minimize taxes as a business owner? I have a whole list here in front of me because there's so many things that you can be doing to do that. Number one, I think, is how you set up your company. So an S corporation has the ability or the privilege of being able to take profits from the company and tax it at the personal level instead of being taxed at a corporate level. So this process also enables you to really minimize your self-employment tax. So what you do is you would take a reasonable salary, is what the IRS says, and you would simply take distributions that would be taxed as regular income. So let's say you made $200,000 as a business owner. Maybe you would take $50,000 in a salary, and then the remaining 150 gets taxed as regular income without the self-employment tax. You can also do this as an LLC if you elect the S-Corp election. So these are things that should be reviewed probably once a year to make sure that you're doing it properly, or that you should be starting to do that process. Typically, business owners will start as an LLC; they just make money. But as the business grows, there's more tax efficient ways to be doing this. Then you have just your regular deductions. You might be able to take a home office deduction if you work out of your home. Vehicle expenses, you can deduct the standard IRS rate per mileage, or the company could purchase the vehicle itself, and then you would depreciate that over time. It's called a Section 179 deduction, which allows for the immediate deduction of equipment purchases like computers, machinery, rather than depreciating it over several years. Cars or vehicles typically get a large portion done at first, and then the remainder over several years. There's also bonus depreciation. So right now, 60% deduction on qualified property as of this year, 2025, and that gradually decreases unless it's extended by regulation. Right now, that has not been extended. So those are things to look at when you're making big purchases for a business, how that affects your tax return. If you buy a $80,000 vehicle, you're not going to write off $80,000 in 1 year. That's going to be written off over several years. There's also thinking about your future. Hopefully your business is growing and it's worth something, but you also don't need to 100% depend on that. You need to put money away in other accounts. So if you're working for yourself, a solo 401k is a great way to defer a lot of money into to be pre-tax. You could get up as much as $70,000 put away, or slightly more than that if you're over the age of 50, into a solo 401k, or just a regular 401k plan if you have employees. You can deduct $23,500 a year, or $30,000 if you're over the age of 50. Plus, you could do profit sharing into the 401k plan as well. There's also SEP IRAs. That's where you can contribute up to 25% of up the $70,000 for this year into a SEP account. But if you do it for you, you have to also do it for your employees, same percentage. Health insurance, that's 100% deductible as well. So if you want to purchase health insurance through your company, then, or do flexible spending accounts or health savings accounts, these are all things that can be deducted directly off your company income. Also think about income timing. So if you have a large contract or something that's happened near the end of the year, you're on the cash-based system, not accrual, then you could certainly maybe delay that until the next year. Gives you a whole another year to pay income tax on that, as opposed to paying just a few months later. You can also accelerate expenses. Often we'll do that in my own company. We get down to the end of the year and realize that we have a large tax bill, but maybe it's time to upgrade some computers. Maybe it's time to do some other large expenses, office improvements, things of that nature, to be able to reduce the income for that tax year. Professional guidance. So financial planning for a business owner, that's tax deductible. A CPA, any kind of a type of tax advisor, bookkeeping, your accounting software. These are all things that are deducted, that I think people sometimes will often miss on their list of things that they should be deducting from their plan, or deducting for their income tax. Other things that you consider, some people have businesses that are creating things. So your R&D credits, that's a thing you can deduct. Your research and development. Most of the people I work with are service-based companies, so we don't have R&D really. But if you have a manufacturing company, you certainly would. So you can create R&D tax credits. You can also pay estimated taxes quarterly. So you could write off your state tax if you pay that through the company as opposed to individual. That's something to think about. And then entity owned life insurance. So if you have a buy and sell package or buy and sell agreement, anything that's owned by the company could be deducted by the company as far as premiums go. If your business has investments and they have losses, that's something to consider. I typically don't want companies to own like stock accounts, but doing tax loss harvesting would be the same thing. If you could create losses there inside a portfolio, that would certainly help. So anyway, these are just kind of tip of the iceberg, big things that we immediately look for when we're doing business planning with clients. And that's something that you can consider as well. Have a great day.